Good morning. Welcome to the second day of Bruegel's annual meeting here in Brussels. The first session of today's event will be on equity, corporate debt and Europe's capital markets. The COVID-19 pandemic will leave states and private agents with much higher debts than what we came into. What will this new higher debt overhang mean for growth today and in the future? What is the role of equity in helping growth given the high level of indebtedness? And what must be done next in the European Union to redress some of the debt bias in Europe's financial model? To discuss these issues and many more that are going to be pivotal for the new growth model for Europe, I'm joined by a very distinguished panel this morning. Welcome, everyone. Let me briefly introduce you to my distinguished speakers. I am joined by Governor Robert Holzmann from the National Bank of Austria, actually physically here in the premises of Bruegel. Governor, thank you very much for joining us. And then the rest of my guests are joining online. Ms. Beata Javorcik, who is the Chief Economist at the EBRD, Mr. Rolf Straat, who is the Chief Economist and Management Board Member at the ESM, and Ms. Sophie Vermeil, who is the founder of Droit and Croissance Rules for Growth Institute in Paris. Thank you all for joining me. We have a big topic to discuss, and perhaps maybe if I can turn to you, Ms. Javorcik, to start a little bit with setting the scene of where we are in terms of the debt overhang, where we are in terms of the level of indebtedness that people and companies inevitably had to carry on, and that include also countries, the sovereign states. And what would that mean as we move forward in terms of identifying the new growth model?
Thank you, Maria. Thank you very much for the invitation. It's a pleasure to participate in this conversation. So let me make 3 points. First, one of the big concerns now is that the debt overhang will negatively affect growth in medium term. As we have seen after the financial crisis during the recovery time, firms that were highly indebted were investing much less, and this effect was particularly strong for firms with debt of short-term maturity. So moving forward, to the extent possible, it would be useful to avoid piling up more debt on firms. So that means that grants, equity, or longer-term debt would be more useful instruments. And the current EU, the new EU recovery package is a step in the right direction in terms of focusing on grants. The key issue here is how to break this vicious cycle between high indebtedness and low growth. Now, as we are helping firms, the second issue we need to pay attention to is how to avoid freezing the status quo, how to allow creative destruction to work. And in particular, what we want to avoid is creating green zombies, rescuing companies that may be viable in the pre-crisis environment, but companies that will no longer be viable once we move to a low carbon economy. And one of the issues that is underappreciated here is political economy. It has not gone away, and there will be fierce lobbying by dirty industries to help them survive. Also, what's very much underappreciated is the lack of awareness among firms. We did a survey of about 20,000 firms in the countries where the EBRD operates. And one of the fascinating findings of that survey was that when we ask firms, if you have not undertaken green investments, what was the reason for that? Almost 2/3 of firms said it's simply not a priority for us. And the same answer was given by large firms and by small firms. So there is a huge lack of awareness. And I think the current crisis provides a great opportunity to build awareness. As another survey we have just finished shows, is that people in countries where we operate, particularly in the new EU member states, have increased their appreciation of the climate change issues as a result of the COVID pandemic. So there's a parallel here, just as in January, COVID was a Chinese problem, and now it's a global problem. Climate change, seems a far away issue that's not touching us at the moment in Europe, but before we know it, it's going to be with us. So we should make sure that we use this opportunity to build awareness, because unless we convince most of the population that climate change is a big issue, we are not going to have popular support for green spending, which is very much envisioned in the EU recovery package. Now, the final issue we need to pay attention to is bankruptcy procedures. Sadly, there will be lots of firms that will need to go out of business, and that needs to happen so that capital and labor are freed, so they can move to new activities. So the challenge that will be facing us is how to deal with it in an efficient and speedy manner. So let me stop here. Thank you.
Thank you very much. This is a very succinct illustration of three very important points. May I briefly come to the second point on the issue of the zombie firms? You mentioned it's crucial not to allow for zombie firms to linger on. So in other words, to allow for creative destruction. How easy is that going to be as we move forward when, we have suspended the state aid rules in Europe? Some countries are choosing to prolong indiscriminate help. Is this something that you think is in the antennas of policymakers, or is this the first order problem right now? Just save everybody who we can't save?
For politicians, it's incredibly difficult to sell the message that we cannot help everybody, and that we are going to give preference to some sectors but not the others, right? And I think what helps here is, one, making the argument that it is key to rescue firms, sectors which will be viable in the long run, even abstracting from green issues. The world has changed. Hospitality industry, airlines are facing sort of medium-term or longer-term problems. And second is, I think we need to find a balance between being radical and yet not moving before we build public support. At the EBRD, we talk about tilting to green, about giving slight preference to green activities, about nudging firms towards better behavior, nudging them towards improving their energy efficiency, doing energy audits, disclosing their environmental performance. So perhaps it's not about extremely radical action, but it's about small steps and nudging.
Thank you very much, Ms. Jaroszek. I'm hoping that I will get also some of the reactions on these issues with the other speakers. May I turn to Mr. Strauch now and bring in the issue of the sovereign indebtedness. The ECB almost immediately reacted to the pandemic, to the shutdown, and intervened in the markets to effectively allow countries to borrow as much as they needed to deal with the immediate threat of the pandemic, the health issues, but then also beyond that, to help with supporting those who need support in the economy. Beyond that, we also have a number of different now EU tools that have come into play. The European budget is in place. So nevertheless, the countries will come out of this with high debts, sovereign debts. We came into the crisis with sizable debts for a number of countries, which means that, and here is the question, what would that mean for the vulnerability of fiscal sustainability for a number of countries, if not a good majority in the European Union, and actually, dare I say, globally. Mr. Strauch, your comments and thoughts on the issue.
Thank you very much. Also, thank you very much for inviting me to the panel. As you said, for us at ESM, it's also appropriate to look at it from the perspective of the public balance sheet, but let me also create a link then to the private balance sheet and what it means. I mean, for me, the main point is after you have had an initial reaction to the crisis, in order to address the fragilities that emerge from the crisis, and I will be more specific on that, and in order to engineer the recovery right, we still need a comprehensive policy response. And I will also be telling more specifically what are the elements, in my view, of this policy response. Now, first we have to acknowledge that the crisis has created a huge cost in terms of securing public health, and this had obviously a clear priority and had to be done. And second, that there was an incredible rupture of capital flows or of cash flows for companies and households, and that required also government reaction. And governments have reacted massively at the national and at the European level. You mentioned that. And in my view, this was absolutely right, the right thing to do, and the necessary step to be taken in order to cushion what eventually turns out to be the biggest recession for a century time. Now, just to give some figures and clarify, still the biggest part of measures are taken at the national level. So far, Euro area governments have dedicated about 3.5 trillion euro to measures related to Corona and the pandemic and crisis fighting. A big part of that actually goes to is guarantees for the banks to support the private sector. On top of that, as you mentioned, Europe has taken relatively bold decisions in order to support this amount overall to 1.3 trillion. And here there was a first package to support workers, firms, and the sovereign. And this is now being implemented by the European Commission, the ESM, and the European Investment Bank, and that amounts to 540 billion. And then there was a second package that was decided of 750 billion. That is the new generation EU, that is the recovery fund that will be implemented over the coming years. So very big steps, but necessary steps, and also the European component crucial in order to preserve a level playing field among member states. Having said all that, it's clear, as you say, that there is an increase in debt level, and that's unavoidable. Now, what is the policy response that is now needed, and what are the different areas here? And first, I think it is clear on the fiscal side that forward-looking, the policymakers have to manage a fine line between support and securing financial sustainability. And that means that measures have to become more targeted and measures have to become more growth-oriented. So far, the priority has been to secure liquidity, to secure cash flows. As we move on, it has to be more turned, and that was already said before, towards supporting those sectors that have growth prospects, to also move from employment preservation to employment creation. So there has to be some change in policy measures. Then, as to the debt sustainability situation, it is clear that the levels will be higher now after the crisis. At the same time, we have to acknowledge that we live in this low interest rate environment and that interest rates will be very low for long. And that creates a different dynamic that we can count on. And economists talk about this difference between R, the interest rate, and G, the growth rate, which now seems to point to the possibility of actually growing out of the debt level and reduce debt levels through growth. And it gives more time for the fiscal adjustment path. That we can see, and that's really a window of opportunity or an opportunity in this regard, but it doesn't say that it is self-evident. There is still the request or the need for governments to do some fiscal adjustment over time, and also indeed to have the growth enhancing measures. But then it can be measured. We also have to acknowledge that along the way, there is event risks. Markets can become impatient, markets can lose easily trust, and when debt levels are high, this can lead to market volatility that we have experienced in the past. So first point, fiscal policies need to be adjusted. Let me now turn to the corporate sector, and only very briefly, because a lot has been said on that and more will be said. Corporate debt has increased clearly, both through bank loans and through issuance in the capital market. So far, we haven't seen an increase in insolvencies and bankruptcies, and that is clearly the result of the policy support measures that were provided. Actually, it is the case that insolvencies and bankruptcies have declined or remained stable. But this is about to change when support measures have to be phased out and we move towards less public support and more capital market support or more private sector support. So this will change, and then there is the possibility that this has indeed long-term repercussions, because one can expect that then bankruptcies will increase, which in turn means that we will be destroying some some equity and some capital. The European Commission has estimated that the overall equity loss, to a large extent also for liquidity purposes, will amount to 720 billion till the end of the year, or could be even to 1.2 trillion. So there will be big financing needs, and those financing needs will continue. I fully agree that those financing needs cannot be all covered by banks and standard loans. So we need to look for alternative sources of finance, and that is the second policy response that needs to come in after the fiscal policies. And then here we need to think about how to get, particularly for small and medium-sized enterprises, adequate access to equity and capital markets overall. How will that migrate through the banks, possibly to the sovereign balance sheet? Again, looking at the current situation, we have to acknowledge that the banks have actually very much improved their position over the past decade as the repercussion of the last crisis. And the EBA has looked at it, the ECB has looked at it, and Governor Holzmann may say more about it. But my reading and understanding of the vulnerability exercises that have been done is that there is quite a significant capital buffer available, sizable capital available, in order to weather the repercussions of the crisis, so that we can take actually some comfort from that side. And in the exercise that the ECB has done also, the assumption is, and the analysis is, that actually the fallout of the guarantees for the public balance sheet may be limited and may be manageable. So I take that overall as a good news, but at the same time, we need to acknowledge that there are three caveats to this, or three notions of caution. One notion being is that what holds for the sector overall may not hold for each bank. So there may be weaknesses that may be unevenly distributed across countries. Second point is, the longer the crisis lasts, the more expensive it becomes. And as we move forward, it will be more complicated for companies, which means more non-performing loans, which means possibly more repercussions for public balance sheets. And that has to be also taken into account. And the third point is that the euro area banking sector still has a profitability problem. And that is also reflected in price to book values, which means that the own capital generating capabilities of the banking sector are limited. So support that is needed will also have to come from the public side. And in turn, that means we need to create the conditions for a profitable banking sector. And that is a big call for the completion of banking union. And that's the third element of the policy response, to move ahead in completing banking union and creating the conditions for a profitable integrated banking market. So far, my view on the comprehensive policy response that is needed: making fiscal policies targeted, geared towards growth, generating financing sources, and third, completing banking union. I stop here. Thank you.
Thank you very much, Mr. Strack. So this is a very important intervention, and you know, if I may dwell a little bit on your last point, because I think this is at the time conjecture where we are right now, the one issue that is being discussed extensively is exactly this, your last point, as to how likely is it that this economic crisis, what started as an economic crisis, may turn out, transform, I think you call it transitioned into effectively a financial crisis. And you know, I am reassured to hear your intervention in this respect, where, I mean, you know, the uncertainty, of course, is very high, but at least the banking sector is in a much better position now in terms of having buffers by comparison to what it was, let's say, 10 years ago when we got into the financial crisis. So, you know, in as much as one can prepare for these things, the banking, the financial sector in general is much better prepared. I would be interested also to hear the Governor's views on this. I hear your plea for completing the banking union. I hope we can also talk about making progress on capital markets union, but I'm hoping we can return to that. Let me then go on to perhaps ask Ms. Vermeij to make her initial points on the one issue that we heard from both our previous speakers. There will be more corporate insolvencies as the fiscal drip stops. When it stops, there will necessarily be companies that will not make it. How well prepared are we to deal with the bulk, whatever that bulk is, on corporate insolvencies? And I know, Ms. Vermeij, you had worked on these issues before. You have specialized on corporate insolvencies. Can you give us your views on how well we are prepared this time, and maybe compare it to you know, the previous financial crisis where we were basically unprepared for something of that bulk?
Exactly. Thank you, Maria. Thank you very much for the invitation. Yes, it's very important to understand that corporate insolvency law is critical in order to tackle the issues that we're going to face when it comes to deal with corporate debt. When we look back and what has happened after the big financial crisis in 2008, we realize that one of the reasons why the US economy managed to rebound faster than the European one was because of their Chapter 11, so their insolvency law. And that's really was a critical exam to do, because after that there was a lot of energy was put on effort made by the European institution to work on better insolvency laws in Europe. In 2000, so 1 year ago, so 2019, there was this restructuring directive approved by the European Union, and it was a major step in order to facilitate the debt equity swap. So what do we mean by debt equity swap? We mean by the conversion of debt into equity, even if there is dissenting creditors and dissenting shareholders in the company. And we understand why it's so important, because when it comes to make sure that all the resources of the company are not allocated to only the reimbursement of the debt, but also used to finance growth, so that means to make investment, it's really critical to make sure that this debt equity swap can occur very quickly. It was really good because, so this new directive reflects to some extent the features of the US Chapter 11. There was also a combination of other laws like the UK scheme arrangement. And it was a kind of big change of culture among member states. It was after lots of efforts, lots of discussion, negotiations. It's not perfect, nothing is perfect in this world, but at least it was the right direction to mention to the member states. So far now, as far as I'm aware, only the Netherlands have enacted the law after the adoption of the directive, so there's still work to do. So the member states have 2 years after the adoption of the directive, so until 2001, so June 2021 to adopt the directive. So there's still work to do, but there are progress which are on the road. On the separate side, the UK is quite fascinating. The UK, even though of course they are not bound by the terms of the directive now, unfortunately, they have already also approved a big reform which is going to change their landscape. What remains to be done? I said the new directive is pointing at the right direction, but is not perfect. for sure, the directive was focused on the idea of restructuring balance sheet, which means big companies, because for small companies, we have, I think, to accept the idea that for small companies, for funders, the best solution is often the liquidation, but provided that we let them buying asset if it's possible during the bankruptcy proceeding. And that's an idea which is difficult to accept by everybody. I think it was discussed by the first panelist. Sometimes it's hard for politicians to understand that maybe the best solution is to let company liquidate it and to find a way to reallocate assets very quickly. And this is still a work to be done for the next directive. I don't know what is the timetable for the EU Commission, but I hope there will be a new project starting very soon. Second, I think if we focus again now about big companies, I think we need to better work on incentive. What does that mean? When it comes to restructured balance sheet, we are talking about people sitting at the table agreeing on a restructuring plan. And we need to make sure that the people around the table have the right incentive to agree on a plan which is sound for the company as fast as possible. Sometimes, because of the incentive of the market participants, there's wrong, it's not always the right agreement which is achieved. And just to give you an idea, for instance, when it comes to bankruptcy trustee or insolvency practitioners, their incentives are in the law, in the bankruptcy law, and if their incentive can go against the maximization of the assets and against the conclusion of an agreement which is done from as fast as possible at the first time. What we see, for instance, right now in France, is that after the big crisis, we have seen sometimes many agreements to be quickly approved out of formal bankruptcy. So it was, in a way, you could say a good achievement. But when you look at it more thoroughly, what you realize is actually there's not enough work done. So the restructuring is not deep enough. So you see many companies again at the table of the negotiation 1 year after, a third time, and 2 years after, and that takes too much time. So we need to find a way to make sure that the markets around the table have the right incentive. The second example I can give is the banks. We have seen over the last 10 years sometimes the banks are reluctant to see their debt, their claims basically be converted into equity, and that's on the best incentive. When I compare the European institution with the US one, is always at the level of the bank when it comes to writing off the non-performing loans. So one of the big achievements that the US have done during the last financial crisis, in my view, but I'm not an economist, I'm only a lawyer, was to force the US banks to actually restructure their NPL faster than the European one. And I think it's really important to bear this in mind and to make sure that we do not do again the same mistake that we've done, I think, right after the financial crisis, because if at the table the bankers do not have any incentive to convert that into equity, because in their portfolio is not considered as a non-performing loan yet, even with the best insolvency law, we won't manage to achieve great things. Last things I think which is important when it comes to insolvency law is the quality of the courts. Even if the objective of the last directive was to convince market participants to negotiate out of court, so in the anticipation of a formal bankruptcy proceedings, it's really important to understand that the dynamic of the negotiations out of court depends of the dynamic of the discussion in court if there is a formal bankruptcy proceeding. So the fallback position, the formal bankruptcy proceeding, is critical in order to favor out of bankruptcy negotiation. And if you want to facilitate the process, you need to make sure that you have the right judge also at the table when there is a formal bankruptcy proceedings and there is a swift process. this was not a mandate. This was not part of the mandate of the European institution during the last reform, and we understand why. It's courts. It's really related to the culture of each country, and it's really difficult to move on this topic and to harmonize. But I think we still need to try to move on this topic because it's really important. And without modern court, without sophisticated judges, maybe judges who have been lawyers before, like in the US, we cannot basically restructure big companies with very complex balance sheets. So I think that's three things to bear in mind. So if I sum up, better laws for small and medium-sized companies, that means facilitating liquidation and the relocation of assets. Second, make sure that the market participants at the table have the right incentive to restructure properly the balance sheet of the company as fast as possible. And third, improving the quality of the courts.
Wonderful. Thank you very much. Very important points. I hadn't associated actually the issue of the encouragement of solving bankruptcy procedures out of court is facilitated by the stricter and more formal court procedures are. This is a very important point. I think that we should encourage the advancement of formal court procedures in order to advance those out of court procedures. A very important point in my view. Thank you very much. And I will come back actually also to the point of the NPLs. If NPLs pick up as we move into the autumn, and your recommendation about a speedy resolution of NPL, something that we also saw in the US, and actually the experience now here is a point understood in Europe, and how to advance with NPLs in the second wave, if and when that arises. But before I come to this point, let me turn to Governor Holzmann and perhaps touch on a different point. This time, Governor, the issue of the alternative tools. Other tools, we talked, all the speakers talked about debt, indebtedness, how to solve the issue of indebtedness on the sovereign, on the private side. What other tools do we have in Europe, and how can we make the best of them?
Thank you. It has been a fascinating discussion so far. Would love to answer to some of these issues here. What I'd like to turn to now is to make a plea that we think more about equity than in order to contribute to the solution of the problems, and to think about it, why we have to think about it, why I think this requires a change in mindset as well as approach, and even if we have this done, why it is quite difficult to get more equity to the market. The first part has been mentioned. We have accumulated a lot of debt, over 330% of GDP worldwide, latest estimate by the IMF, which of course makes things pretty unstable. Why now at a specific situation where we are at the coronavirus, where banks are still well positioned, one question asked, but where the banks, if this continues, will run out of money or the willingness to lend, even if they have the money, so where equity has to be brought to the table. But this adds to a longer-term need already, why we have to think about equity. The first one has to do that the euro needs a capital market, but this capital market needs to go beyond safe assets. So debt instruments, we need to have more also equity instruments on the market. So we have a stability argument. A second one has to do that it's also an important part for an improved efficiency, because equity is something which is good for productivity, something important for innovation. And since Beata mentioned the part of creative destruction, when you want to weed out who makes the decision, is it the politicians, is it the banker? Or do we need, how to say, the private sector to make some of the decision who survives, not survives? So the efficiency part is important. And last but not least, we also have a distributive part. There are always a lot of complaints that the wealth distribution is unequal. Well, if you have so little widely distributed wealth, of course the wealth distribution is unequal. But in order to do this, this required something which I would call a move towards a democratic capitalism. Because if you want to have more equity, where's the capital coming from? From the outside of Europe? From a few rich people? Or don't we need also to have more smaller capitalists there, much more largely distributed? And this is, of course, then the question, where's this money coming from? Why do people save? Well, it still holds that the majority of people save a lot of money for life cycle events. And the big life cycle events are having your own housing and having your own pension. So if this is provided through different means, there is little incentives to save and there's no little capital to come in from the market. And you need this also because you need to have people with skin in the markets. Because if people don't have, feeling the market is up for them, they never get involved and they never get this kind of possibility of the investors to be careful what he's doing with his money. Now, okay, let's solve this. Let's assume we have solved this. Then the question is, how is the supply and the demand coming together? Well, even if people were to save for their own pensions and have an account there, how are they bringing them, the money then to the demander? There are too many asymmetric information issues involved that supply and demand will come together. And this shows very clearly worldwide, but also in Europe. So it requires institutions, it requires pension funds, it requires investment companies. You sometimes have investment companies that raise 100 million or so in order to invest in smaller companies. But this is small fry compared, let's say, to the 1.3 trillion money put on LTRO from the banking system on the table. So you need to have a much larger approach to this. And last but not least, also it's not only the supply side and the pooling there, you also need the better pooling on the demand side. It leads to the issue of the share market. On the share market, changes have taken place, but they're still dominated by larger firms. Small caps are still, complicated to establish, even if there have been changes there now. And so the question is, how can we make sure that firms go out? And here we have seen also major changes in recent past. And there was recently, actually yesterday, an interesting comment in the newspaper that when Amazon in '97 went to the market, it was there to raise money for their own investment. Nowadays, and a recent coming to the market was not to raise money, but to put money back to the investor, because before there was private equity there, and they're there, and now the firm is very valuable. Now they want to have the money distributed. Now they go to the market. Now they get public in order with the new money to put money back to the equity owners. So we have different things there, which need to think through how do we make a better distribution of the equity, how to bring it to the investor. That's not an easy part. And last but not least, and there are many issues, okay, how do we favor equity compared to debt? And one of the major reasons why there's much more debt than we have equity has to do with the taxation system. Current taxation system favors debt because you have the deduction of interest rate compared to the own interest on equity. So we have to think also what are the kind of incentive mechanism. So yes, we have to go back and go back to equity, but the way there is fraught with a number of conceptual and operational issues for which we don't have yet a good answer.
Indeed, and if I may, and you mentioned it very clearly, I think, is, capital markets require scale. This is what we need. We need scale, and this is why I think the ambition of the European Union is to create a market union to precisely achieve that scale. This is a project that has been with us for some time. There has been directives. We've made regulatory progress there, but we haven't made beyond the regulatory progress. We haven't made progress in creating the markets themselves. In your view, what is the one thing that we need to do to advance this agenda? I know this is not an easy question, given we'll be busy with this, but what would breathe life into this, new life into this project?
I think one has to go beyond thinking one can do it by the order of the Mufti, simply doing declaration. You have to lift the capital market. Capital market is like British weather. Everybody is talking about it, but nobody's doing anything against it or for it. So we have to really think about capital market needs to be there where an individual has a view, I want to be there in the market. I invest there directly or indirectly. I get interested in it, so I have to have a mindset. So you have to, that's the reason I use the notion of democratic capitalism. We have to think, if we want to have a capital market, we have to have many more smaller capitalists. Otherwise, we will never have a capital market.
So a cultural revolution.
It's cultural. It's a cultural revolution, yes.
And cultural revolutions will take a long time to implement.
Exactly. It's not from the day to tomorrow.
Indeed. Thank you very much. Let me perhaps bring our audience into the conversation. I now have two senior fellows at Bruegel that are asking pretty much the same questions. So this is Alicia Garcia Herrero as well as Francesco Papadia, are asking a question about how European institutions can help countries accelerate growth, especially countries that are lagging behind in this respect, like Italy. Can I start with you, Mr. Strauch, on this issue? Because you come from the European, one of the European institutions that is thinking about these issues, how can these institutions really help accelerate growth and stay faithful to the architecture of the European Union?
Yes, that's obviously a very important part.
And a big question, actually.
Very important question. So, I mean, I talked about the European package, and it is clear that in the crisis response, ESM mainly is meant, and we have created an instrument as an immediate response to the crisis in order to support health measures. And the other institutions have done that as well. I think forward-looking, the key role is with the European Commission clearly, and with the structure of the Recovery Fund. And as part of that setup, there is also the idea that money will be provided upon the delivery on a recovery plan that governments have to draw up. And that recovery plan should essentially be the core bone of the government thinking in stimulating growth. So what this system or what this approach entails is that we have, in my view, a fundamental change in European governance in the sense that compared to the past, here we have now where you had policy coordination as a surveillance system. We have now added to this a huge positive incentive that governments can count on if they embark on growth measures. And that is something that will have to be operationalized, but that would, I think, would be a centerpiece of moving governments towards more growth-friendly policies.
Wonderful. Thank you very much. May I go back to the question of the NPLs? I think one of the manifestations of debt becoming problematic is that the non-performing loans, the bad debts, will increase. You know, what are some of the lessons that we've learned from the previous crisis, and what can we do differently this time to try and achieve exactly what Ms. Vermeij also said, so a quicker resolution of bad debts if and when they arrive? And may I turn to you, Ms. Javorcik, on this issue, just to hear from your experience from the BRD. What is the one thing that we need to do differently and quicker this time around?
I think there is no silver bullet. I very much agree with what was said before, that we need better procedures for liquidations, something akin to Chapter 11. We need faster, more efficient courts. And if you look at the global rankings of ease of doing business, which also include efficiency of courts, many Southern European countries, not just Eastern European countries, are not looking very good in those rankings. They are actually lagging behind in that respect. Also, another reason why the US did better in this area than Europe is because in Europe, we have a stigma attached to bankruptcy. I think it's hard for people who have been unsuccessful in business to start again, while the mindset is very different in the US. So here we need a cultural revolution as well. But let me bring another issue to the discussion. As firms will be weighed down by burden of debt, are we going to see nationalizations? What is quite interesting, what we've observed over the last 2 decades, is that the public attitude towards state ownership has become much more favorable. And it's interesting that if you look at surveys, you see this development both in industrialized countries as well as in post-communist countries. And there, interestingly, there isn't a link between increasing support for public ownership and age profile. It seems to be sort of uniform increase. So does this mean that we are going to see a wave of nationalizations? And if so, I would very much worry about nationalizations taking place in countries where the quality of governance is lower, because in those countries, nationalizations will create entrenched interest. State-owned entities will create an opportunity to give jobs to connected individuals. There will be networks of suppliers that will be very much fighting against reversing those. And I think, this is one of the lessons from the countries where EBRD operates, is how do you ensure that nationalized companies in places with lower levels of governance are run efficiently and not used for political purposes.
Thank you. That's a very important point, and actually the role of the state will change in the future as a result of the huge interventions that we've seen. And if we've seen even a greater wave of nationalizations, this will only add to this. We will actually have a whole session on this tomorrow on the role of the state in view of the COVID-19. But thank you for raising it, because this is a very important point. May I ask a question to the governor? It's coming from Alex Lehmann, also a fellow here at Bruegel, who is asking, Governor, should the flexibility in capital requirements under Basel III be utilized to encourage banks into debt equity swaps or to set up common equity funds? Would it be a way of thinking about equity?
I haven't thought about it, but first reaction is, hunch reaction is, yes, sir, because given the difficulties to bring equity to the table, every approach which does it quickly, I think, should be supported. And that equity swap would be one way in which this can be quickly done, because it requires information which is essentially publicly available. The question still is there, how to say, where's the equity coming from? Because if a bank wants to get rid of it, and the question is, where's the equity coming from? Who is the investor in that? And this goes back to the question, who wants to invest in equity compared to that? And this is, how to say, this question which will occupy us for the next decades, I assume.
Yeah. I'm very tempted to ask the question again on NPLs, if I may address it both to Mr. Strauch and to Mrs. Vermeij. The issue of a European bad bank, do you think that may be preemptively, and also to answer the question as to what European institutions can do to help with promote growth, and particularly in areas of low productivity, the quick resolution of NPLs? Is there space for thinking about European bad bank, or has this ship sailed? Mr. Strauch, perhaps I can start with you.
First, it is true that we have to think about solutions for non-performing loans, and we have had an NPL action plan after the last crisis, and I think it has been very successful and helpful in bringing down the level of non-performing loans. So there is a lot of steps that can be taken on the side of the industry, and also from the regulatory side. Would we need additional steps, and should one think about bad banks? There are different models of bad banks or asset management vehicles that one can think of. There can be at the national level. One can also obviously think of a solution at the European level. However, one has also to be aware for a European solution, it's not cost-free. In order to aggregate the market that has additional requirements, it also creates additional operational costs. So a centralized solution may not be necessarily the most efficient one if it were necessary. So one can handle those things possibly also at national level. Andrea and Ria has at the time proposed a model for asset management companies that can help in those situations, kind of a blueprint on which governments can build when they set up those companies, those bad banks. So there is already some work, intellectual work done in order to go that route. And I think we also need to be conscious that this cannot be the only solution, but that other steps need to be taken. And here, for example, it's also very important to mention Capital Market Union.
Exactly.
Part of the Capital Market Union project that was discussed by a high-level forum that was created under the leadership of Thomas Wieser, they emphasize also very much the necessity to revive, strengthen securitization. So it would be a bad bank by itself wouldn't help if you don't create the market conditions. And that is what needs to be done, and so that there would be a lot of other measures necessary to be successful.
Yeah, Mr. May, your view on this?
Yeah, I think that before thinking about setting up bad banks, I think we have to ask ourselves who are the bankers at the table. So just to give you an idea, in some banks in France, the bankers at the table are the same one who actually arrange the loans. So they have the previous relationship with the debtor. In some other big banks, it's actually the restructuring team, and they have their own balance sheet. And you can understand that if there has been a transfer of the loan inside the same bank from the balance sheet of the team who was in charge of arranging the loan to the team who is in charge of restructuring the loan, it means it's already a first step, because the people at the table are not going to have the same incentive. The restructuring team at the table, who has received in its balance sheet the loan, they already been in the bank. The recognition that it's a non-performing loan on the restructuring would have better incentive actually to restructuring the loan. If the same loan stay in the balance sheet of the team who has been in charge of arranging the loan, considering the past relationship they have with the debtor and the future relationship that they may have in the debtor for new loans, there are going to be this resistance actually to agree to convert properly the debt into equity. So I think there's this small organization that with best practice to look at various banks, how they deal with that. And I know, for instance, that in the US bank, the culture about restructuring loan is greater than in Europe, or maybe we should have a better look at what's going on in the European banks in terms of dealing with the non-performing loans and organizing restructuring teams.
So, Governor, you will have also views on this issue?
I sympathize very much what has been said. I think taking the loan outside the old environment is very helpful because it changes the incentives. And what we have seen in Central Eastern Europe was that having bad loan companies or taking care of it has in most cases been highly successful in gaining a lot of money back in order to serve the former owners, but also to have a mechanism to put, if you want to some extent, new equity to the market, because the money came in with new investors there. So I would very much favor that, to think about it, how to bring it out, to make it happen. And also what has been said before, I think one should really look at the current regulation to make really sure that banks have an incentive to reduce the non-performing loans as soon as possible. I think this is a pressure which fosters equity, because this could be one way of doing with it, but also making the bankers sure that they can focus on what is their capacity, is lending, and if things are not there because something went wrong, to bring people in who understand something about investment. So I think this is something we should
So
think about.
timeliness
Exactly. Timeliness plays a huge role.
I think we have learned that also from the previous crisis. So if we were to be confronted with that, that would be a good policy advice. As we're coming to the end, I'd like you to perhaps ask one big question to all my panelists in terms of what happens next. I mean, the way that the way you evaluate the risks. I appreciate that we're living in a world of very high uncertainty. The possibility of the corporate sector getting into trouble is there. The possibility of that feeding into the financial crisis is there. And of course, we're starting from a point where the sovereign is already overexposed and already highly involved, as well as other policy institutions, so from the ECB to all European institutions now, doing whatever they can to help. What, in your view, is your number one priority? What would you like to see change as a policy response, in the immediate future, not in the long term? You know, in an effort to try and prioritize policy steps and actually concretely say what are the next steps that need to happen in order to support growth in what is undoubtedly a very, very uncertain environment. And perhaps we can go back the same order as we started. Your number one policy priority that you would like to see implemented in your own jurisdiction of interest, but more globally, if that at all helpful. I know I appreciate this is a difficult question, but it is one that is going to help us understand, in my view, what policy options are available and are in fact implementable in the short run. May I perhaps start with you, Ms. Javorcik, simply because we started that order.
With any policy, with any institution, the devil is always in detail. So to me, the key priority now is to make sure that the EU Recovery Fund will be a game changer when it comes to long-term growth. And this will also send a strong message to equity markets that now is the time to invest in equity in Europe. And on our side at EBRD, we are very active in equity markets. We support development of those markets in countries where we operate. We participate in equity funds, and we ourselves also take equity. So make sure you use the money well when it comes to EU Recovery Fund, and pay attention to equity markets.
Wonderful. Thank you very much. Mr. Strauch, I'm sure you will second that.
So thank you. In a way, I do understand your question of priorities. At the same time, I must say, I want to reiterate the message that I had from the start. I think it's about a policy package, and there is no one magic bullet. I think we need to get the recovery right. Getting the recovery right requires different initiatives that should go in parallel. And we have this challenge of getting fiscal policies geared towards growth, of getting the financing, and I agree with all what Governor Holzmann said also on the need for equity and how to push that democratic capitalism, and we should get banking union fixed. These are my priorities.
Okay, in the package, that's fair enough, is a prerogative. Ms. Vermeij.
As it was said, the devil is always in the details, and I think the priority is to make sure that all the member states transpose properly the restructuring directive, and as it's draft, there's a lot of room for negotiations, and because there was some last-minute compromise to be made, I hope that the member states will try to replicate the feature of the Chapter 11 as much as possible, basically.
Thank you very much. Governor Holzmann, you have the last word.
It's of course tempting now saying things about monetary policy, but since in the quiet period I'm not even allowed to say so, so go back to something which not in charge is. But I think what has been said there, we need to restructure, and we came into this crisis with policymakers empathetically wanting to save everybody. So everybody, every enterprise should be saved in order to overcome it. I think it's time now where we move, what has been said, into selectivity, which is much more difficult because it requires selecting and triage. And this is a part where I think policymakers need encouragement. There's also what has been said, they should not rely too much on public ownership, because public ownership, as we know, has not been conducive to productivity growth, to entrepreneurship. And what we need in order to overcome the crisis in economic terms, but also in social terms, is that we gain the creativity of the individuals to move towards the new frontiers. It's not only defreezing what has happened before, we have to be open and use the crisis as an opportunity to implement digitalization, to have the green agenda and everything there, but with a new entrepreneurial spirit. And I think this is something which we would like to see.
Wonderful. I think we are coming to an end now. Let me, first of all, thank you all for taking the time to participate in this panel, participating in Bruegel's annual meeting. Governor, thank you very much for actually coming to Brussels. I hope we will be able to resume our normal activities sometime in the future. Thank you for very concrete suggestions and for helping us think analytically about what is inevitably a huge problems facing the pandemic. In the meantime, let me also wish you all to stay safe. Thank you for participating, and also thank you to the audience for tuning in. We're having more events today, and I hope you will always stay tuned in. We have more to discuss. In the meantime, again, thank you very much for participating, and I hope to see you in person sometime in the near future. Thank you again, and goodbye.
Thank you all.
Bye-bye.
Bye-bye.
Thank you. Thanks very
Bye-bye.
much. That was wonderful. Thank you.